Hello and welcome. Moss Adams is pleased that you joined us for today's session, Economic Update, a Potential Return to Low Inflation. Before we begin, I'm going to play a brief video.
Welcome and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, now that we have our housekeeping video out of the way, I would like to turn the floor over to Dustin Brash, partner at Moss Adams. Dustin?
Thank you. Welcome, everyone. On behalf of my colleagues at Moss Adams, we're excited to have you all with us for today's economic update. I've known John Mitchell for many years and always look forward to hearing what he has to say and looking forward to getting right into it. So please join me in welcoming John Mitchell.
Thanks, Dustin. It's very nice to be here at this extraordinarily exciting time to be an observer of the U.S. economy. I mean, here we are in mid-August, and look at what's going on. You've got recession drumbeats. You read about recessions all the time. We've got rising employment, falling GDP, an annual inflation rate at multi-decade highs, and I suspect for just probably about everyone on the call, this process of high inflation and wringing it out is a new experience. You know, if you lived through the 60s, 70s, early 80s, you've seen it before. Financial markets, of course, the first half was dismal. Since then, we've had a rally through in July. And watching Jerome Powell, I mean, he's really channeling Paul Volcker, who was the architect of bringing down the rate of inflation in the United States back in the late 70s and early 80s. We've got global turmoil, a stream of outlooks being revised downwards. If you look at forecasts, you know, of the Fed, World Bank, etc., you see people revising things down. We've got fascinating conflicting goals. You know, at one level we talk about decarbonization, and then we got to produce more oil and gas. We've got to have more housing. We're dealing with monetary policy to crush out inflation, which has an impact, obviously, on housing. The upturn is likely in its 3rd year. I mean, we started up in the spring of 2020, and we've got this fascinating dichotomy and I'll talk about a little bit later, you see depressed consumers, but they appear to be hanging around the malls because retail sales and spending has held up or has been rather resilient. And then policy surprises. I mean, 2 weeks ago, we thought Build Back Better was dead, but then we get Joe and Chuck having secret meetings, and now we've got it passed. So lots of policy uncertainty. Well, let's talk about output. Okay. Now, you saw the 2 quarters of decline in 2020, the second quarter a decline at an annual rate of over 31%, but then it bounced back. Now, most recently, the last 2 quarters have been down. The recovery, I mean, we've made up the losses during the recession. That was done in mid-2021. But if you look at what's going on, and it's got a lot of press when you see headlines, the economy shrank, for example, in the second quarter. If you look at the detail, okay, consumer spending on goods subtracted a little over 1 percentage point. Spending on services added, almost 1.8 percentage points. There were huge swings in inventory change. And I think this is important. In the second quarter, inventory change subtracted 2 percentage points. In the fourth quarter of last year, it added 5.3 percentage points to the growth. So there's a lot of noise in inventory, and I'll get to that in a second. Net exports in the second quarter added 1.43 percentage points. Residential subtracted. And there were some interesting things. Selling oil from the petroleum reserve, that's for GDP purposes is a decline in non-defense spending and an increase in inventories as it's transferred to the private sector. The inventory stuff is fascinating. Over recent years, prior to the pandemic, really going back to the latter part of the last century, you've seen a lot of reduction in inventory levels, going to just in time. Well, the pandemic and supply chain problems disrupted that. Now there's more just in case. We had port backlogs, major changes in demand. When you see big changes in demand for, bicycles, personal computers, that kind of stuff, you can get inventory imbalances. You get supply disruptions. In a world where there are significant supply disruptions, you might say, well, I'll just increase my order. And then if demand changes, all of a sudden you have inventory problems. So we've had major swings in inventory accumulation over the last few quarters. And I think it's important to remember that. We don't know how that's all going to sort out. From an employment perspective, now on the graph here, I've taken out the months of decline, March and April of 2020. And then we started up in May. Now remember, in March and April of 2020, we lost about 22 million jobs. And look at the rebound. Started in May of 2020, and it's continued every month with one exception, December of 2020. If you'll remember, we had a renewed outbreak. So it took 29 months for us to make up for the decline in jobs that we had during the pandemic recession. Now in July, you'll remember, got a lot of press, the employment gain, the net gain was over 528,000 net jobs. Okay, that was way above expectations. The unemployment rate is back to where it was in February of 2020. But one of the interesting elements, the participation rate, that's the fraction of the adult population in the labor force, working or unemployed, 62-1. It was 63-4 in February of 2020. So the labor force participation rate has declined. Been estimated there are about 5.9 million people not in the labor force. They're not looking, but they want a job. I mean, those are some of the elements in the labor market. But you travel around, and I suspect you continue to see signs of, hiring, help wanted, and people complaining about not being able to get enough people. I mean, 3.5% in a long-term sense is a very low unemployment rate. Now, let's think about this work pattern, okay? In the summer of 22, what is your work pattern compared to during the 2021 pandemic period? No change, you're in the office throughout, back in the office full-time, hybrid, or still fully remote. See how people react to that. I think the question we have to ask is how serious is the hybrid model going to be? Wow, that's interesting. In the office throughout, small, but look at hybrid, 50.9% and 23.6% fully remote. There was a piece from the American City Business Journal, some research out of Stanford, that thought we're about 30%. We're going to end up being hybrid versus 5% prior to the start of the pandemic. So, amongst this group, which would make sense, probably a white-collar group, significant changes. You think about the implications of that for real estate demand. Okay. Let's go on to the next one. Now, there's some hints of slowing in the labor market. If you look at the JOLTS data, the job openings and labor turnover, the most recent is June, 10.7 million job openings, down from 11.3 in May. The quits rate, the fraction of people quitting their job, non-wage and salary employees quitting their job, was unchanged at 2.8. That's a relatively high number in a long-term look. In June, there were 6.5 million hires and 5.9 million separations. Both of them declined slightly. Separations include layoffs, firings, quits, any number of reasons that people leave jobs. Initial claims, and I don't know what the numbers were this morning, but they've been creeping up from 50-year lows, but are still, in the 250, 260,000 range, which is low in a long-term sense. If you look at the number of people employed plus the openings, it's larger than the labor force. I mean, that's a sense of tightness. The Beige Book, which the Federal Reserve puts out before it meets, is interesting. Anecdotal evidence and stuff shows up there early. Noted nearly all districts reported modest improvement in labor availability. Then came July. If you remember, when that July number came out, people were stunned because it was twice what had been expected. So, I mean, labor markets seem to still be very tight. Now, the fun stuff now is inflation. Now, we saw the July numbers, consumer price index up 8.5% on a year-over-year basis. The core, which excludes food and energy, was 5.9. The personal consumption expenditure index that the Fed likes to use, 6.8 with a core of 4.8. Now, you put this into perspective, okay? Back in 2020, the rate of inflation was 1.2%. 2021, 4.7. Look at what's happened on that graph on the left. You can see during the pandemic in 2020, extraordinarily low rates, close to zero. You know, that's when gasoline prices collapsed, hotel rooms, airfares. Then as the recovery got going, you saw those numbers bounce up a bit. But then, as you've gotten into 2021, look at the surge. Now, it's a global issue. It's important to point out. June data, European Union, year over year was 8.6. The United Kingdom was 9.4. A lot of you probably saw your papers this morning. The United Kingdom data came out yesterday. It was over 10. And then just to make us feel better, Turkey was almost 70%. In the year to July, food up 10.9. Gasoline, 44%. But gasoline, of course, had been coming down. It was up close to 60% the month before. New cars at about 10.4, shelter 5.7. Now, one of the interesting things about having the price increases in food and gasoline, of course, those are things that we see on a regular basis. Driving down the street, we go to the grocery store. We're more familiar with those prices than we are for many other. So I mean, so they get a lot of attention. The July index was unchanged from June. You had a decline in energy prices, and that was largely responsible for that drop in the headline number, which is widely reported. You see it on the graph. We were over 9 and then dropped down to that 8.5% range. But of course, that's still well above the Fed's target. Now, I've got to revert to a previous life as an economics professor for a minute. Think about prices. I mean, prices are signals. They convey information. I mean, we don't have to know anything about OPEC or the Ukraine conflict or tanker rates. It's all summarized for us in the price of the pump. It conveys information. Relative prices allow us to make trade-offs. If we do this, for this price, we give up what we otherwise could have done for these prices of other things. Prices are incentives. Prices are incentives. Relative prices rise. Firms and individuals that can supply that product have the incentive to do more. I mean, the price system is an amazing system for organizing, allocating, and using the dispersed knowledge in our society. You know, in recent years, it's not been a major issue. Now, it's problem number one for the population. I mean, it hasn't been problem number one for a long time. It was back in the 70s. You know, there's some old issues, you know. My raise is from my hard work, and I'm really bummed that it's gone because of rising prices, okay? I've never been this old before, and I live around a lot of older people, and when you see falling assets, unindexed pensions, plummeting real value, there's a lot of angst, okay? There's unexpected redistribution. Lenders, lenders, borrowers, pensioners. I mean, people who borrowed 30 years with a 2.5% mortgage are smiling. The people who lent those funds ultimately are not. You get those kinds of transfers. We're taxed on inflation. Inflation running 8.5%. I'm getting 3% in my money market fund, and I'm taxed on that. And it's not even, the real value is declining. You shift in focus to how do I protect myself? Not necessarily long-term investment, but how do I protect myself? We've got an unemployment rate of 3.5%. I don't mean to make light of that, but that impacts relatively few compared to inflation. Inflation impacts everybody. We all see those prices. Now, if you look at some of the detail at what we've been through, it's sort of fun to do this. Think about energy. Now, in the spring of 2020, I mean, energy, gasoline prices absolutely plummeted. People weren't driving, people weren't traveling, not commuting. Prices, in some cases, some of the prices actually went negative. But now we've seen a rebound in demand. Then you look at what's going on in the Ukraine. Russian invasion response, trying to cut Russia off, not dealing with Russian oil. And then in Europe, you have weather that results in weak performance of renewables, wind not blowing, that sort of thing. The Germans decide they're going to shut their nuclear plants down, and although that may have been reversed yesterday, and try to wean off Russian gas. Now remember, natural gas is an internationally traded commodity. Decades ago, that was not the case. So we feel those prices. For a while here, there was a war on fossil fuels. It perhaps doesn't lead people to invest in that. Reduced investment incentives. Then the tight labor market, suppose you're a fracker and you want to increase output in response to the higher prices, you got to find people, and it's hard to find people. And then there was this long-term plan, we're going to reduce oil and gas, so people reduced refining capacity. Then all of a sudden, demand explodes, and you've got rising prices. Now, think about the food stuff. Okay. Drought, and you've all seen the pictures, the dramatic pictures in the last few weeks of drought in the southwestern United States and other parts of the world impacting production. Russia-Ukraine conflict, major wheat, corn, sunflower producers, fertilizer coming out of the same area. Then fertilizer, of course, needs natural gas. The transportation disruptions, the avian flu, okay, reducing the supply of chicken or impacting the supply of chicken and eggs. Labor supply issues, processing and transporting. So you've got rising food prices, around the world. The housing shortfall. You've all read a lot about rising prices, rising rents. That works its way into the system in rents and the rental equivalent of owner-occupied homes, but it works in with a lag. The pandemic distortions. For a while, we bought services, or we bought durables like mad versus services. We didn't go out to eat or travel. Now you got that stuff shifting back, postponed gatherings, weddings that have surged, hotel airfares, hotel rates, car rental rates, major swings in demand. And then shutdowns elsewhere in the world due to the pandemic interrupting global supply chains. Then let's conduct an experiment. Imagine an island, a factory, and a store. Suddenly a helicopter flies over and drops money. Okay. What would happen to prices? People could just race around, pick up that money, and spend it. Well, I think you can see that we'd probably see an upward impact on prices. Well, what did we do during the pandemic with monetary and fiscal policy? We put out a lot of money, gave people money, and they spent massive stimulus. Okay, some of that is still out there, so there's likely an excess demand element to this process. All right, let's think about how this group thinks about inflation. You've all lived it. Inflation was 1.2% in 2020, 4.7% in 2021, will be near 7% in 22. What do you think is going to happen next year? The Fed's trying to bring it down. We'll see if we have a room full of optimists or pessimists. Okay. 4 to 6 next year. Yeah, okay. Well, lower than this year, but clearly not back down to the Fed's target. A small group think that we may get back down to the 2 to 3% range, and then 23% think it's going to remain above 6. I don't think the Fed would like to see the results of this survey. Okay, next slide. All right, thinking about consumer confidence. This is the University of Michigan survey. There's Michigan survey and the Conference Board survey. And what I think is interesting, if you look at the consumer confidence, University of Michigan, notice it's down basically at the level that you saw during the Great Recession. Okay. It's lower than it was during the pandemic recession, but it's back down near the levels that you saw back in the 2007 to 9 time period. I mean, inflation is very upsetting to people. Now, since this slide was put together, the index bounced up a little bit in the August number, but it's still relatively low. Yeah. People are concerned. We'll have to watch the changes in behavior induced by the changes in relative prices and falling real incomes. And you've all seen discussions in the financial press, more house brands, combined trips, change shopping patterns. I love when you see newspapers talk about demand destruction. Now, I'm assuming everybody on this call has had a basic economics class, and demand curves slope downward to the right. And so rising prices, all other things unchanged, would be expected to reduce the quantity demanded. And we've seen that play out in some areas during this run-up, the run-up in energy prices. Now, in response to this price pressure, we've seen the Federal Reserve start to act. Jerome Powell said earlier, restoring price stability is an unconditional need. It is something we have to do. The Fed began to raise rates and is unwinding its balance sheets. We've seen 4 increases in the federal funds rate. Okay. Now, think about how monetary policy works through the economy. I mean, higher rates. Some spending is going to be impacted. Oftentimes, we look at housing as mortgage rates rise. You think about asset prices. We've seen for a while significant decline in asset prices in the first half of the year. Stock prices, bond prices. We've seen a strengthening in the dollar for part of that time, helping to making it more difficult for U.S. exports. I mean, the Fed has embarked on a path, similar to what it did at earlier times when inflation was a problem. Okay. Now, over on the right-hand graph there, we've got the 10-year, and you see the 10-year bond surged and then has come down off the highs. It came down as we saw that lower inflation rate come out in the last month, and people were concerned when they saw the big jump in the labor market in the July numbers. It's very volatile as people try to figure out what is the Fed going to do. Okay. If you look at households, the Fed does this survey of net worth of households and nonprofits. And it's interesting, you look at the decline, for example, in the first quarter of 2020, decline of about $6 trillion. Then it bounced back, and it's gone up every quarter since the first quarter of 2022. In the first quarter of 2022, financial assets were down by $3.1 trillion. Remember, what happened to the stock market in the first half of the year? You saw it plummet, and that pulled down net worth by about $500 billion. Houses were still going up, but the financial assets went down. And that may be one of the things that over time will be a drag on consumer spending. But what's interesting, and the last day I could put this together, Standard & Poor's S&P 500 was down 11.66 on the 10th of August. It had come back substantially. We've seen a big run-up in the market since July. Not all the way back, obviously. And the question becomes, is that a bear market rally or a dead cat bounce or the start of the next up leg? And nobody knows. Housing is one of the things that, of course, you look at when you see rising rates. We went through this heady period in 2021, the preferences for housing, the pandemic, the demographics, years of underbuilding. So the housing was relatively strong. Okay. Now, if you look at what's happened, affordability is deteriorating. Affordability is declining because of rising prices and rising mortgage rates. The Case-Shiller May data, national index up 65.7% since July of 2006. Everybody on the call, presumably, can remember that the housing bubble in 2005-06. House prices are way above that now. In the year to May, they're up about 19.7% year over year. It's a paired index. Same houses. Tampa, Miami, and Dallas at the top. Federal Housing Finance Agency, the purchase-only house price index. All states were up. This is first quarter 2022. Florida was number 1. North Dakota was number 50. The deteriorating affordability, you really got to worry about that. There are generational implications. The New York Fed in February does a survey on housing, and renters view the probability of them owning a home is at record low levels. Now that has sort of generational implications because the houses, of course, are a path to increasing assets, increasing wealth. Now, existing home sales, and we had new data come out this morning, they're not down for 5 months, they're down for 6 months. So that continues to be impacted and will be a drag. I got a list of the people that were going to be on the call and pulled the house price index for the first quarter. This is the purchase-only house price index from the Federal Housing Finance Agency. These are the same houses over time, mortgages purchased by Fannie and Freddie. And then I got building permit changes for the first half of the year compared to the first half of 2021. Actually, it's sort of interesting. You see a lot of states had strength in residential permits. Everybody had prices going up. Look at Florida there at almost 30%, Idaho at about 26%, Montana, Tennessee. But the point is, everybody had rising house prices, and those house prices were going up obviously faster than incomes. Here's an affordability issue. And you see the way building permits, some sharp declines, but a lot of states, they held up okay. Fiscal policy, this of course has to keep changing. So think back to the cycle. We had the CARES Act. You all remember that. And then the Omnibus COVID Relief Act in 2021. Then the American Rescue Plan in 2022. More stimmies, funds for state and local governments, etc. Then in 2021, we had infrastructure, the infrastructure bill, about $1 trillion. The CHIPS Act in 2022, a few weeks ago. The Inflation Reduction Act, which is just a matter of a day or so old. It came out, you thought Build Back Better was dead, then it came back and with a new name, Inflation Reduction Act. Climate change elements in electric vehicles, battery incentives, renewables, increased business taxes, more IRS agent, Medicare negotiating drug prices, and then later in the decade, deficit reduction. It's a big deal with major potential long-term implications. We'll talk a little bit about later. Then you sort of sift through the data, looking at what's going on. 4 rate increases and the higher rates are working through the system. Real incomes are declining with higher prices. We have an inverted yield curve where short-term rates, the 2-year is above the 10-year. A lot of you know that is oftentimes a harbinger of recession with a long lag, an uncertain lag. Recession headlines in the media, and most Americans, look at number of polls, think that we're in one. You got global weakness in Europe, China. You have the energy threat in Europe, the COVID response, the lockdown stuff in China that impacts production. But we've got tight labor markets and strong balance sheets, not major credit problems. There's evidence that people are shifting away from pandemic behavior back to more normal spending patterns. Less in the way of durables, more in the way of services. Consumer spending rose in the second quarter. The second quarter disposable personal income rose at a 6.6% annual rate. You saw this week, like Walmart's earnings held up, better than expected. Retail sales, were resilient. So it's a mixed bag. Now, you can make the recession case. You can say monetary policy is going to tighten until it lowers inflation, and that's likely to induce a recession. We've got these supply shocks, energy, food, war. They're not over. We could get more. The falling real income, the inversion of the yield curve, the decline in asset prices, global weakness, and COVID is still out there. Okay, there's a lot of things you can point to. Then on the other side, you can say, hey, we'll maybe get a soft landing, slower growth, but not a marked decline, not a broad-based decline in economic activity. You look at the labor market strength, the 528,000 jobs in net jobs in July. The balance sheet. You look at the debt service ratio and the financial obligations ratio. They're below where they were prior to the pandemic. And yeah, housing's weakening, but this is not 2007-8. There's still a lot of support, demographic stuff. Building permits have not collapsed. They slowed, but there's underlying demand still there because of lack of building. And, we had higher quality underwriting. There are hints of supply chain improvement. Ships are more available. Shipping rates have come down. People have reported that it's easier to get stuff. And then importantly, the expectations of inflation are not baked in like they were back in the 1970s, when people had been experiencing year after year of high inflation. There's a lot of things you can look at. Now, the current situation led many to expect a recession. What do you think, if there is one? And when I use the word recession, I'm an NBER defined recession, a broad-based decline in activity. If there is one, what is your expectation for the start time? Okay. No recession fatigue. It's already started. Now in 2023. Well, that's very interesting. That a lot of people, the largest element is that we are in one. It's going to be very interesting. Data gets, a lot of the data is going to get revised. In the second most between now and the end of 2022. Okay, well, if we do this again, it'll be interesting to see how this plays out. Well, if we look around, this is from Job Growth Update, comes out of Arizona State University and the Bureau of Labor Statistics. They rank states by year-over-year employment growth. And when I've done this presentation from Moss Adams, I always like to use this thing when you have people from all over the country. One of the fascinating things about this is you look at it, this is the most recent data, all 50 states are growing. Nevada was number 1, Wisconsin was number 50. But everybody's growing. Okay, that's very unusual if we're in a recession or at the start of a recession. But that's where we are at the moment. Now, I went for the states that were going to be represented, I went and pulled the unemployment rates, June, and then checked the employment relative to the peak, which was, of course, February of 2020. And what's interesting, if you look around the country, now this may look very different with the July numbers, because the July numbers nationally, we got above pre-recession levels. But you look around and you see, okay, I mean, Alabama, almost there. Arizona's above pre-recession levels. California, 99%. Colorado, Florida, Idaho, well above. Texas above. You know, lots of places very close. But you look at those unemployment rates and then think about your life, okay? Those are low numbers, okay? We've got tight labor markets. That's where we are. You know, April 2021, or no, April 2001, month one of an 8-month recession, 14 states were declining. January of 2008, month one of an 18-month recession, 7 states declining. March of 2020, month one of a 2-month recession, 22 states declining. Now, none. So, I mean, this does not look like the start of others. The Fed is likely to keep going until there is more evidence of falling inflationary pressures. And I don't think that's there yet. Many of the supply shocks are outside our control. Drought, avian flu, and then we've got this wild card stuff out there, rail and dock workers. Now you had the mediator make a suggestion in the rail situation here yesterday. But I just mention that because those are wild cards out there that could disrupt things. So what do we got? At least a slowdown and slide into a different world. 2022, growth 1.5% to 2.5%, a wide range, okay, down from 5.7. Slower growth in 2023, the 1% to 2% range. Inflation 6.5 to 7.5 this year, up from 4.7. Next year, 3 to 4.5. Expect it to moderate. The London Economist, which is a weekly magazine, they made the point in their July 10th issue that policy uncertainty and the dispersion of outlooks are at very high levels. There's not a narrow consensus on what's likely to happen. And lots of policy uncertainty. We don't know monetary policy and the fiscal policy that we've seen emerge in the last 10 days. People didn't see that coming. Okay. The pandemic, if you think about it, has demonstrated different models of work, as indicated by the answers to the where you work question in this earlier today. More locational options, different real estate footprints, not fully sorted out yet. How many are going to be going back to the office? The supply chain shifts. All of a sudden, there's pressure to have more inventory because of the possibility of disruptions, to develop alternatives, okay? And look at the locations, friend-shoring. We've seen that emerge. If you're going to locate alternative sources, make sure they're in a place that's friendly. And then from a national security standpoint, okay? So it's not the pre-pandemic world anymore. Now, financial markets have declined. How has this altered your behavior this year? Are you investing the same way? Take a long-run view. Maybe you do that because you're young. The decline in my net worth has made me more cautious with my family spending, more concerned about retirement, more risk averse. Assets are on sale. I've been buying on the dip. I've been accumulating liquid safe assets with now higher returns. That's interesting. No, I take the long run view. That suggests to me you're probably not close to retirement, that sort of thing. Decline in my net worth, a few people more cautious, assets are on sale, buying on the dip. That's interesting. A lot of you have just taken that long run view, which I think history suggests is probably the way to go. Now, let's just look ahead here. Think about 22, 23 considerations. How are consumers going to respond to the price shocks and the higher rates? We've seen the evidence of slowing on housing. Will we see more evidence of changes in behavior? That's going to be fascinating to watch. Will the supply shocks fade away with increased production and supply chain fixes? I mean, there's some evidence that that's starting to happen. And that, if you remember when people first talked about inflation, it was the thought that a lot of it was transitory. Well, if the supply shocks fade away, we get increased production and supply chain fixes, that will reduce those elements to the extent that they're there in the price level. You worry a lot about the end game in Europe, in the Ukraine-Russia conflict, and of course our involvement, the implications for energy and commodities. Okay, how is that going to end? Okay, I think we have to be concerned about that. And then how far is the Fed going to have to go? When will they next pivot? Now, you've seen a lot of excitement lately when the lower inflation number came out saying, oh, the Fed will not have to raise rates as high as we thought before inflation slows, and they'll be able to take rates down sooner. Others argue, no, don't overreact to one number. We still have a significant inflation problem. I mean, wage growth rates are still well above where they would be to achieve the Fed's targets. We don't know how far the Fed is going to have to go. And I suspect the people on this call will watch that very carefully. There is a lot of uncertainty. And then you think about the last week. You think about the long-term implications of the CHIPS Act with billions to assist the semiconductor industry and research, that sort of thing. Now, some of that is a result of the pandemic and us looking at where stuff comes from, and so urging to develop domestic capacity. Very much a move in a protectionist direction. What are the long-term implications of that? In terms of industry saying, hey, I need that kind of protection too, and trying to get funds through the political process as opposed to markets. The Inflation Reduction Act Okay, fascinating, 700 some odd pages, but you've got the drug price limits, Medicare negotiating with pharmaceutical companies. The worry is, down the road, what are the implications of that and the price controls for drug research and new cures? That's a risk. We don't know. The electric car incentives. How fast will people respond? Okay. The infrastructure. The fact that to get some of the incentives, a lot of the production of the batteries and so forth has to be done here with elements that are not really sourced in the United States. The higher business taxes, the taxes on buybacks, who pays them? I mean, business doesn't pay taxes. They're either the owners, the employees, or the customers. So who's going to pay them? That'll be a fun matter for academic research in the years ahead. Now, when we get to a situation where people are concerned about recession, I think back to one of my favorite quotations from a columnist from Barron's magazine. This is probably 25 years ago, Copen Tan. And he said, like beer bellies and bald spots, it is very difficult to be precise about the onset of a recession until the evidence becomes overwhelming. Thank you for your attention.
Thanks, John. I had one question. It's come up in a number of conversations I've had with CFOs and CEOs over the last several weeks, and that is the commercial real estate and the leasing market. You know, there's a lot of uncertainty about what that's going to look like in light of your polling question about where people are working and how they're working. And I'm just wondering if you had any thoughts in that area of commercial real estate.
Well, yeah, I do. I was very interested in that 50% number, 50% number hybrid, whereas some of the national data is a bit lower, but still up substantially from the pre-pandemic era. I mean, I think that supports the notion that you are going to have a weaker demand, particularly on the office space stuff, for commercial real estate. And some properties will be transitioning to other kinds of uses. I mean, people have gotten accustomed to not the same kind of commute, or at least having the option of working elsewhere part of the time. I think there's definitely going to be real estate implications of that. We haven't seen a lot of it yet necessarily because leases have to expire.
That's right. Wonderful. Well, we're 2 minutes from the top of the hour. John, thank you as always. It's so great to hear your insights on things. I'm sure everyone has learned quite a bit over the past hour. So thank you again, and thanks all for attending.
Thanks.
All right, I'm going to jump in here. Thank you, Dustin, and thank you, John, for a great presentation today. And to our audience, if you met all CPE requirements, your CPE certificate is available to download now in the CPE progress window. And then a copy will be emailed within 3 weeks should you have difficulty downloading it now. And then as a reminder, if you attended today's presentation in a group and would like to receive credit, you must complete the group attendance sheet that's found in your console. And finally, here's a link to an online survey for today's presentation. And thank you for joining our webcast. We hope you'll join us again next time. Take care, everyone.